Volatility doesn't change our next guest's positive view, however. Joining us to preview Canadian earnings season and explain why she's raising some cash and increasing exposure to U.S. equities, Diana Avigdor, Vice President, Portfolio Manager, and Head of Trading at Barometer Capital. She's at the TSX. Diana, we're in a new quarter. It wobbled, certainly on the first couple of days of trading. Let's talk about the expectations for earnings season and the fourth quarter. What are you telling investors in terms of earnings season?
Our narrative in the last few months has not changed, despite the volatility that we've seen in the market. Our models are still showing a positive bias, but this has been a tough market to navigate, as you mentioned. You had to be, and you have to be still, in the right sectors. With the volatility increasing, correlations are likely to increase as well. And what that means is that the market and the sectors will move more in tandem. So that means that it's going to be less of a dispersion between the sectors over the next little while, but I think that's possibly temporary. You see the energy sector today, despite the fact that that oil price is down, some of these stocks started to rebound a little bit. From our perspective, the sectors that have been leading will continue to lead over the long term, and so we're still looking at the financials, healthcare, technology. Yeah, and yes, our U.S. exposure has increased a while ago. We are now more overweight U.S. than Canada and very low weight in energy. We raised some cash, or had some cash, which is relatively high in a market like this, about 7%, to weather the volatility that we've seen in the last 2, 3, 4 weeks even.
Diana, you mentioned financials. It was a terrific place for bulls to be up until about September 8th in Canada, and then the banks rolled over, declined about 5% from those highs, and they were all-time highs, generally speaking, for the Canadian banks. Are you looking to come back to the Canadian banks, or do you prefer insurance companies?
We're still there. We've taken the 3, 4, 5% decline. I mean, when you're in a stock and you've done an X amount of profit, 3 to 5% is not a reason to get out of the sector if you feel that the growth and the balance sheets and the dividend growth and the earnings have been right on track. You know, the financials, the Canadian market in general has been for sale globally, and so I'm not surprised that the financials have also been part of it. Don't forget that they're the most liquid stocks on the TSX alongside a couple of large cap energy stocks, and when the global manager wants to invest in Canada, they tend to have those stocks, and when they need to raise country or decrease country exposure, those get taken along for the ride. But 2 to 3 or 4% are not significant. We think that looking over the volatility, through the volatility, I think that there are solid investments. To your questions, do we prefer the insurance companies? I think that within this sector you can diversify. They're all working. We do own Manulife and Sun Life. Financials here in Canada, those are our Canadian exposures. And in the U.S., we have some of the U.S. financials as well.
Just sticking with because you mentioned some of the energy names, which are bouncing today, as you said, CNQ, Suncor. But you'd like a little bit of a different approach to the energy sector, Keyera, AltaGas, Inter Pipeline. Inter Pipeline actually had it was almost 10%, let's call it 8% decline from the recent peak. Did you hold during that kind of pullback? Is there time to maybe add to some of these positions?
I think it could be time to add to the positions. From our perspective, we've had a phenomenal success with Inter Pipeline, for example, in terms of profitability in our portfolios. One of the things that has driven the stock has been some index rebalancing, and then there was some corresponding sell-off as a result, alongside volatile markets and negative commodity tilt. The midstreamers, these are the midstreamers. We kept this as our energy weight in the portfolios. You know, things are never all in, all out. You do overweight and underweight sectors. Our energy exposure is very low. but where we have it, these are the stocks that we prefer. They have an outlook of dividend growth, between 8 and 11%, depending on which stock you're looking at. And, they're less exposed to the oil price and more to the volume in the market. And we know that there's lots of supply out there, and we know that we need the technologies to move them around. And so these are stocks with solid balance sheets, great free cash flow growth, and great dividend growth.
And Diana, you said you said a lot of interesting points, but the one about the international portfolio managers, when they leave, they sell, they come in to the most liquid and they leave from the most liquid. They're not doing that just for a month. So if there had been some selling, whether it's the banks or the big Canadian energy companies, what will make them come back? Or is this just kind of at the margin and still the big players remain well-weighted Canada?
I always felt that international managers misunderstood Canada sometimes. They've called our housing market wrong. They've called our financials wrong throughout the crisis. Canada is often a small percentage of their portfolios, but we feel it a lot. So if somebody's portfolio, a large asset manager, and their portfolio exposure to Canada is 5%, that's an overweight. And when they take it down 1%, we feel it. So I think that since the commodity super cycle has finished, let's say, where a lot of asset managers had Canadian dedicated funds, which was the real flow that's kind of exposed to Canada, and that's less. The generalist geographical weights are in and out all the time, just raising cash from wherever it doesn't hurt their total portfolio too much. So I'm not looking at them as a proxy for what really will happen. I do think that from our long-term perspective, the commodity super cycle, it may be a little slower. And so from our perspective at Barometer, our models are not telling us to go into commodities yet. China is slowing, that's a problem. I think that when we've seen gold outflows out of these managers, at some point that's going to dissipate too. And even though you're not bullish on gold because you are bullish on the US dollar, there could be a short-term trade. These things move a lot. They can move 5 to 10% without anything fundamentally changing.
Diana, on the gold front, it ain't happening. It ain't happening today. The price of bullion down.
Not today, and it's broken down technically. Yeah. And
we will watch it all. Thanks for joining us.
My pleasure.
That's Diana Avigdor, Vice President and a Portfolio Manager, Head of Trading at Barometer Capital Management. She was at the TSX. Diana, thank you very much.